Welcome. Today we are exploring the backbone of the Indian financial system, the fixed income market. This market isn't just for big banks, it's where the government and corporations raise the capital needed to build infrastructure and grow the economy. We'll break down how bonds are priced, who the major players are, and how you, as a retail investor, can now participate directly. Government securities, often called Gilts, are considered the safest investments because they are backed by the sovereign guarantee. They range from short-term treasury bills to long-term, dated securities that can last up to 40 years. State governments also get in on the action through state development loans to fund local expenditures. Who actually buys these billions in debt? As of March 2020, commercial banks held over 40%, followed by insurance companies at 25%. Interestingly, the RBI itself holds about 15%. This mix is vital for market stability, ensuring that there is always someone ready to buy or sell these risk-free assets. How do we know what a bond is worth? It's simply the sum of all future interest payments and the final principal, calculated in today's money. Here is the golden rule: bond prices and interest rates have an inverse relationship. If the market interest rate rises above your bond's fixed interest, your bond becomes less attractive, and its price falls. To be a pro investor, you must know these 4 theorems. First, the inverse price rate link we just discussed. Second, bond prices actually gain more when rates fall than they lose when rates rise. Third, long-term, bonds are like a seesaw, they swing much more violently when rates change. And finally, bonds with lower interest rates, or coupons, are more sensitive to market shifts. The market relies on primary dealers, specialized firms that buy directly from the RBI and resell to others. They provide liquidity so you can sell your bonds whenever you want. Overseeing these dealers and banks is FIMMDA, a voluntary body that sets the code of conduct and standardizes documentation for the entire fixed income and derivatives market. The game changed on November 12, 2021, with the RBI Retail Direct Scheme. Now, any individual can open a Gilt account for free directly with the RBI. You can participate in primary auctions or trade in the secondary market. No commissions, no middleman fees, just you and the government's debt. It's a great way to diversify into safe, long-term assets. Finally, we have corporate bonds. Unlike G-Secs, these carry a risk of default, so they pay a higher interest rate, known as a spread. Always check the credit rating, AAA is the safest. We also have intercorporate deposits, where companies with extra cash lend to companies in need. These are usually short-term, 90-day deals and are a vital part of corporate liquidity. That's Unit 32. We've covered everything from the math of bond pricing to the new ways you can invest. The fixed income market is complex, but it's the engine of the economy. If you found this helpful, don't forget to like and subscribe for more deep dives into the Indian financial system. Question number 1. What are government securities, G-Secs, popularly known as in the financial market? Option A. Corporate bonds. Option B. Gilts. Option C. Junk bonds. Option D. Equity shares. Answer: Option B. Gilts. Question number 2. Which entity conducts the auctions for government securities in India? Option A. SEBI. Option B. National Stock Exchange, NSE. Option C. Reserve Bank of India, RBI. Option D. Ministry of Finance. Answer: Option C. Reserve Bank of India, RBI. Question number 3. According to the bond theorems, what is the relationship between bond prices and market interest rates? Option A. They move in the same direction. Option B. There is no relationship between them. Option C. They are inversely related. Option D. They only move together when the coupon is high. Answer: Option C. They are inversely related. Question number 4. Which of the following is a short-term government instrument with a maturity of less than 1 year? Option A. Dated securities. Option B. State development loans, SDLS. Option C. Treasury bills, T-bills. Option D. Perpetual bonds. Answer: Option C. Treasury bills, T-bills. Question number 5. What is the minimum amount, face value, for which government securities are issued? Option A. Rupee 1000. Option B. Rupee 5000. Option C. Rupee 10,000. Option D. Rupee 25,000. Answer. Option C. Rupee 10,000. Question number 6. Which scheme was launched by the RBI on the 12th of November 2021 to allow retail investors to buy G-Secs directly? Option A. ASBA scheme. Option B. Retail Direct Scheme, RDS. Option C. Sovereign Gold Bond Scheme. Option D. Liberalized Remittance Scheme. Answer. Option B. Retail Direct Scheme, RDS. Question number 7. In a uniform price auction method, which of the following is true? Option A. Every bidder pays the price they quoted. Option B. All successful bidders pay the same cut-off price. Option C. Only the highest bidder gets the securities. Option D. Bidders pay a premium based on their yield. Answer. Option B. All successful bidders pay the same cut-off price. Question number 8. Which organization acts as the self-regulatory organization (SRO) for fixed income and derivative markets in India? Option A. MFI. Option B. FIMMDA. Option C. IRDAI. Option D. PFRDA. Answer. Option B. FIMMDA. Question number 9. What is the most common tenor for borrowing in the intercorporate deposit (ICD) market? Option A. 7 days. Option B. 30 days. Option C. 90 days. Option D. 1 year. Answer. Option C. 90 days. Question number 10. Which bond rating indicates the highest level of safety and lowest risk of default? Option A. BBB. Option B. A. Option C. D. Option D. AAA. Answer. Option D. AAA.